Buying a home is supposed to be the cornerstone of financial stability. It is the decision most financial advisors, parents, and conventional wisdom point to as the responsible choice for building long-term wealth. But the math behind that advice is more complicated than most people realize. This video runs a 30-year simulation comparing renting and buying in the same market under the same conditions. We track every dollar flowing into each path: mortgage payments, rent, taxes, maintenance, insurance, investment returns, and measure where each path leaves you at the end. The answer depends heavily on the numbers you start with, and in many scenarios, the conventional wisdom does not hold. Every simulation requires a defined starting point, so let us be precise about what we are modeling here. The home in this simulation costs $400,000. Lenders typically require a down payment of 20% as the minimum threshold for avoiding private mortgage insurance, an additional monthly cost that would otherwise apply to this loan. That upfront requirement equals $80,000. The mortgage covers the remaining $320,000. The interest rate is 7% and fixed for the full loan term. The term is 30 years. These reflect US market averages as of 2024. The monthly payment on that loan works out to roughly $2,130 per month for principal and interest alone. Property taxes, homeowners insurance, and maintenance are added on top of that figure. For the renter, the same $80,000 that would have gone toward the down payment is invested instead. It goes into a diversified index fund on day one. Historical average returns for this type of investment run about 7% annually over long periods. Starting rent is $1,600 per month. Rent increases at 3% per year, matching the historical average for most US markets. The buyer's home appreciates at the same rate. All figures are in today's dollars. We are not adjusting for inflation to keep the comparison readable. In the first year, the buyer makes mortgage payments totaling about $25,000, but not all of that builds equity. At 7% interest, a large portion of early payments goes toward interest rather than principal. In that first year, roughly $22,000 of the total payment goes to the lender as interest charges. Only about $3,000 reduces what is actually owed on the property. This ratio shifts over time. By mid-loan, the balance tips and more of each payment reduces principal than pays interest. But the front-loaded structure means the buyer spends most of the loan period paying primarily for the cost of borrowing. On top of the mortgage, the buyer pays property taxes. The average effective rate in the United States is about 1.1% of home value per year. On this property, that comes to roughly $4,400 annually at the purchase price. As the home appreciates, this figure rises alongside it. Homeowners insurance adds roughly $1,200 per year. Maintenance and repairs are the most variable cost in the homeownership. Financial planners commonly estimate 1% of the home value annually. On this property, there is $4,000 in the first year. Like taxes, this cost scales as the home's value increases. The combined total for housing in the first year runs roughly $35,000. That figure includes the mortgage payment, taxes, insurance, and maintenance all together. At the end of the loan term, the home is now worth roughly $970,000. It has grown at 3% per year across the full period. The mortgage is paid off and the buyer owns the property outright. To calculate net position, we subtract total housing expenditure from asset value. Mortgage payments alone over the full term total about $760,000. Adding taxes, insurance, and maintenance across the loan period pushes total housing expenditure to roughly $1,200,000. The home is worth roughly $970,000 at maturity. Transaction costs on a future sale would subtract about $8,000 from that figure. The renter starts with the same $80,000 that the buyer used as a down payment. Instead of buying, this money goes into an index fund immediately. Monthly rent starts at $1,600. It increases at 3% per year, matching the same rate as home appreciation. total rent paid across the full period comes to roughly $940,000. The renter also invests the monthly difference between the buyer's cost and the renter's cost each month. At the start, the buyer is paying roughly $2,900 per month when taxes, insurance, and maintenance are included. The renter pays $1,600. The monthly gap is roughly $1,300 in the first year. That gap narrows as rent increases annually while the buyer's fixed mortgage payment stays constant. Around the midpoint of the loan, the renter's monthly payment has grown to roughly $2,200 through compounding rent increases. In the later years, the renter is paying roughly as much per month as the buyer. In the early years, however, the renter has significantly more cash available each month. All of those monthly savings go into the same index fund as the original down payment. The monthly contributions are invested at 7% annually. They compound over the full loan period alongside the original lump sum. By the end of the period, the renter's investment portfolio has grown to roughly $2,200,000. That total reflects the original $80,000 down payment compounded over decades, plus the accumulated monthly savings contributions invested along the way. The renter owns no home, but they hold a substantial liquid investment portfolio. Here is where the simulation lands at the end of the period. The buyer holds a home worth about $970,000, mortgage-free. Total housing expenditure over the term was roughly $1,200,000. The renter holds an investment portfolio worth roughly $2,200,000. Total rent paid over the full period was roughly $940,000. On net worth, the renter comes out ahead in this simulation. The outcome is driven by the difference in growth rates between the two assets. Home appreciation compounded at 3% annually. The investment portfolio compounded at 7% annually. Over a 30-year period, the difference in growth rates produces a significant divergence in final values. Compound growth favors the higher return asset, and the math accumulates over decades. The result reverses under different assumptions. If the home appreciates faster, say at 5% annually in a high-demand market, the buyer's equity position grows significantly. If investment returns fall below 7% during flat or high inflation periods, the renter's portfolio underperforms the projection. In markets where rent is already close to or above the buyer's full monthly housing cost, the renter's early monthly savings advantage shrinks towards zero. The 30-year simulation favors the renter under our assumptions, but buying can still make sense depending on how long you stay. Buying a home involves significant upfront transaction costs. Closing costs on a purchase of this size commonly reach about 3% of the price. Those fees alone can easily exceed $10,000 before the mortgage even begins. When you sell, transaction costs apply again. Real estate agent commissions and closing costs on the seller side typically consume about 6% of the sale price. On a home at that price level, the exit costs approach $50,000 at the time of sale. These transaction costs mean that buying only makes financial sense if you stay long enough for appreciation to cover the round-trip fees. Financial planners commonly use 5 years as the minimum holding period before buying becomes competitive with renting, all else being equal. The break-even period extends in high-cost markets where the price-to-rent ratio is elevated. In an expensive market with a ratio above 30, the break-even window can stretch beyond a decade of ownership before transaction costs and opportunity cost are fully recovered. In a low-ratio market like those found in the Midwest, the break-even can arrive in as few as 3 years. This is why the timeline question matters as much as the market question. If you are likely to relocate within 5 years for work, career change, or lifestyle reasons, the financial case for buying weakens substantially, even in a favorable market. The costs of entry and exit consume appreciation that has not yet had time to accumulate. The numbers are not the full picture. Homeownership provides stability that a portfolio balance cannot replicate. A homeowner cannot be asked to leave when a lease expires. The ability to renovate, build community roots, and remain in place long-term carries real value. That value is not captured in any spreadsheet. Tax advantages also apply to many buyers. Mortgage interest may be deductible depending on the tax situation. Capital gains on a primary residence are excluded up to a federal limit when the home is sold. Tax law changes since 2018 have reduced the deduction's impact for some households, but the capital gains exclusion remains meaningful for long-term owners. Equity is also a form of forced saving. A renter who invests the monthly surplus requires consistent discipline over many years. Many households do not maintain that discipline reliably over a full loan term. The homeowner's equity builds automatically with every payment. For people who struggle to save consistently, the enforced structure of mortgage equity can produce better real-world outcomes than the theoretically superior renting strategy. On the other side, renters carry flexibility that buyers simply do not have. Flexibility has real financial value that most people only recognize when they need it. Moving for a better job, downsizing after children leave, or relocating to a lower-cost city are all significantly easier for a renter. A homeowner who needs to move quickly in a down market faces transaction costs and timing risks that can erase years of appreciation. Rent versus buy does not have a single universal answer. The correct choice depends entirely on your specific variables. The math favors buying when the home appreciates faster than investment returns, when the buyer stays for a very long period, and when local rent is high relative to purchase prices. The math favors renting when the market is overvalued, when the buyer's time horizon is uncertain, or when investment returns consistently outpace home price growth. The most important number in this decision is not the home price or the interest rate. It is the price-to-rent ratio. Divide the purchase price of a home by the annual rent for a comparable property. A ratio below 15 generally favors buying. A ratio above 20 generally favors renting. Most major U.S. cities currently fall well above the favorable threshold for buying. San Francisco and New York show ratios above 35 in many neighborhoods. The math there heavily favors renting at current prices. Cities like Cleveland or Memphis sit near 15. Buying there is the stronger financial position for most buyers. The answer really does depend on where you are. Running the numbers for your specific market, with your specific down payment and your expected time horizon, produces a more useful answer than any national comparison. This video gives you the framework. The variables you fill in are the ones that actually determine the outcome. Sources are listed in the description below. If this was useful, subscribe for more breakdowns like this. Drop a comment with your city and whether you rent or own. Let us know whether the numbers here matched your situation.